Thank you, and good morning to everybody. I would like to start with the name of our presentation, that is the beginning of a new cycle, because we think is a new cycle and a new start really for our country. And to understand why we have this idea, we need to go probably back some time ago, say more or less 3 years ago, and use a sentence of a politician, not an Italian politician, but a German one, so probably more reliable. And that Mr. Schäuble, that say more or less 3 years ago, that the problem in Italy is not the real data, that some is good, some is bad. The problem is the lack of trust. And that was certainly what created a number of problems in Italy, in the market, and that is well shown in the two trends that we have here, that are the trend of the stock market and the trend of the spread between Italian treasury bond and German treasury bond. And you see that the one on the top part is the stock market that went down 30% from January 2011 to November 2011, and the spread that went from 130, 150 basis points to almost 600 basis points, so 5 times again to November 2011. Why November? Because in November, there was the majority of the analysts thought that Italy was close to default, but something happened. And what happened here, I think, is well represented in this slide. And there was the end of an era, Berlusconi one, and an era, and I have to say that in 1994, so 20 years ago, when Berlusconi stepped in, there was a lot of good sentiment about him, and probably he wasn't completely wrong, but certainly the result has been a failure, and it was time to move out, and in effect, he moved out. And with the help, obviously, of Mario Draghi and his very strong commitment to defend euro, and technocrats that come like Mr. Monti, then we had the coming of something new. And I have to say that I don't know how much foreigners can appreciate the fact that we went from a prime minister that he's 78 years old to one that is 38 years old. In Italy, the biggest problem is unemployment of the young people. And it is true that the young people has not any certainty, any hope in the future, much less than any other country. The fact that a prime minister, so the most important job in the country, has been taken by a 30-year-old is a great sign. I personally believe that the man has the chance to do a good job for Italy, but we have to see. But certainly now there is someone that can give a vision, and spread and share price of the stock market show an opposite trend of the one before, and we are now back in January 2011 with the number. So, looking at some economic data, the PMI for retail sales rose at the highest level in 3 years. There was consumer confidence recorded a significant increase in March, and in the shopping center that we manage in Italy at CBRE, we manage 50 shopping centers, so we have a very good sample of what is going on. We have, for the first time in the first quarter, 3 consecutive months of increase on the previous month of the previous year, on the month of the previous year, since July 2011. So a sign that consumer confidence is back and consumption start to rebound. Looking at general economic data, you see that the average growth for 2014 to 2016 is very much in line with most of the other European countries in Italy. And if you have a further look to what is considered, quite rightly, the major problem of Italy, that is the debt, we would like to take a slightly different angle. Add the public debt to the public debt, the private debt, the situation in Italy is not as bad, because if we do that, we see that Italy is better positioned in terms of portion of debt of countries like United Kingdom and Spain, and very much in line with countries like France. And only Germany is certainly better than all the other European countries. So the total debt is very much on the average of Europe. More important for consumer consumption, so for all the retail and the economy, is another number, that is the percentage of the debt against the disposable income. Here, Italy scored #1. Basically, the Italians have debt that are more or less 60% of their disposable income. UK has debt that is 150% of their disposable income. Basically, if the Italians decide to consume much more and to leverage on that, so leverage like UK, the GDP could grow at an unbelievable number. That means that, obviously, the disposable income is, I think, a good measure of the potential of the future consumption. And here there is a huge potential and no leverage. Finally, on the debt side, there has been research showing that it's important what is the debt now, but it's also important what is the debt in the future. And the best, say, estimate of the debt in the future, taking account pension plan, welfare cost, etc. And if you add up the two at the day one now, Italy is in the best position. Clearly, that take in assumption a number of things that can change in the future. But at the moment, if you take implicit and explicit debt, Italy again score #1. Going to real estate, what's been happening in the market? On the global market, the situation improved consistently in America, and now also in Europe. Not only the core countries like UK and Germany that has not suffered too much after 2010, but also the rest of Europe. There is now a lot of investment that come with money, particularly from US, but also from sovereign fund from Asia Pacific. And there is a strong competition on diverse investor base. What is in Italy? We think we are at the beginning of a cycle, because there has been a huge repricing that was what we needed for, and a number of steps has been taken. And as I say, there is the beginning of a new sentiment with a new political guide. That I think is extremely important. Reform has to be taken, very important, the labor reform. But I think we are now on the right direction. Investment show that in 2013, we had an increase of 85% on the turnover of the previous year. And most of these investment, 75% of these investment were done by international investors. And this trend is confirmed in 2014. What's going to happen in 2014? I think is difficult to estimate, but we try to compare the situation in Italy and Spain, that are obviously two fairly comparable countries, and we have taken the average turnover of the last 10 years and looks at what's happening in 2013. And the turnover in 2013 of Italy has been 16% lower than the average of the last 10 years. In Spain, has been 20% higher of the average of the last 10 years. I mean, it's obviously not a scientific data, but is confirmed by the fact that prices in Spain are ready to start to be increasing, while in Italy are fairly stable. So it is clear that there is a potential for further allocation of capital and further investment.